Good afternoon, everyone, and welcome back to the new video. I know I am uploading after the wrong time, but my semester exam are just over and I am just back on track. And today we will start with chapter 10 of what is option and option market mechanics. So I will upload the previous chapter as soon as possible. Let's go with chapter 10. It is an important and basic chapter. Everyone should know it, and let's start without any delay, right? So yeah, we are in our board and it's been long time. So in this chapter we will run about what is option, terminology, and how it's work, types of option, taxation, and more focus on exchange traded option, right? How to move it? Let me think. Got it. Yeah. Wait a minute. Yeah, I got it. So let's go with types of option. So there are only two important type of option: core option and put option. Yeah. So core option is a derivative, right? Which give right to buy certain product, what we say certain commodities or asset at future with a strike price specified strike price, but do not have obligation. Like in futures, if we enter into a contract, then we have to buy it at T end. Let's say we are at T0 and we enter into future contract, and at T end we have to buy it. So we have to buy even if the spot price is less than the strike price, right? But in option, if the spot price is right, let's say core option we buy it if the spot price is below the strike price, and we will lose money. If we will lose money, then we will not buy it, we will not exercise it, right? We will not exercise it. That is a core option. And similarly, put option option give holder right to sell. In core, remember it, we buy it, and in put we sell it. Okay. So core, generally it is a case where the core we earn money if the spot price is more than strike price, and input what we say, we speculate that the market will go down and we will earn money if the market go down, right? If k is bigger than st, so this difference is a profit for pool, and this is a profit for core, right? It's so simple. Right to sell at future time at certain date and price, but do not have obligation, right? Apart from this, there is a what we say difference between future and option. In future, if we remove all the tax or exchange fee, there is no what we say no fee or no money required to enter the contract. Required to enter the contract. But on the other end, we have an option to enter exercise it or not. I will tell you what the meaning of the exercise, the option. So that is, so to like which we have a feature that we can exercise the contract at the end. To have this feature, we pay a premium, we pay upfront money to enter into a contract. That is called premium. Premium is upfront money required to enter into option. So in future there is zero premium, and in option there is a premium based on the where is the stock price and everything. And all quant finance, the pricing team is mainly focused on to calculate which premium is best, that all the future cash flow is equal to the present money of time, right? Present capital, right? And then after this, what we say, we let's see, we some terminology related to option. First is European and American. I will tell you what is American. Second is spot price or asset price. Third is uh, expiration date, expiration date or maturity date, right? So European option and American top option. First, remember that it have nothing to do with geography. European option is a type of option where we can exercise. So what is meaning of exercise? Exercise is selling or entering into opposite side, entering into opposite side of contract. If we buy the call contract, so at exercise it is right, the contract terminate or we enter into uh, opposite side of contract, we sell the contract. If we buy it, we sell it. If we sell it, we buy it, or we let it expire. So it is it happen at maturity date. So let's say contract end at 7 June. 7 June is a expiry or maturity date of a contract, and the spot and asset price is a price of underlying asset that option is made on. So like the stock price is a spot price. So spot price is a stock price at that time of time frame, right? And European option is a type of option that we can exercise at maturity only. So we can sell or buy it, or we enter into opposite side on 7 July only. In between the 6 month or any time period, we cannot do anything. So and but in American, we can sell it or buy it or exercise it any day, at any day. If we want tomorrow, we can sell it. Yesterday, after 1 month, we have a freedom to exercise it any time up to the expiry date, right? Up to the expiry date. So that is some terminology related to option. Yeah, and European option is easy to analyze, easy to make, easy to price. American is little bit harder, but achieve. Most of the option traded on exchange are American option, right? So let's see about core option P off, right? Core option. So let's say let's take an example of price of option P $5, and the strike price. Yeah, I forgot strike price. I think, yeah, I forgot the strike price. So strike price is a price. It's a contract price. The price written in the contract to exercise, or the price written in the contract is a strike price, right? I will explain it better. So call option and strike price is 100. So let's say see the call option on this. This is our graph, right? And this is our in y-axis we have asset price or a spot price, and this is profit and loss on y-axis, right? X 0, and it's go negative. Let me bring it further. Right, so let's say summation to 70, 80, 90, 100, 110, 110, 120, 130, right? So we paid $5 upfront at time 0. It is time 0, and right, we paid $5. So let me plot the profit 200, 300, 400, right? And it is -1 to -5 to -10. So we paid right -$5. So the strike price is k equal to 100. So we will earn money if the spot price is bigger than k. So profit कब होएगा? Profit will happen when st is greater than k. So till then we will be at loss of $5 because we paid $5, right? So at 70 we are at loss, 80 we are loss, at 90 we are loss, and at 100 we are at the money. So there is a concept of at the money, inter money, out of money, right? So at this time we are out of money because our contract value is 0, so we are out of money. And at 100, so we are equal to strike price, right? So we are in negatives, that's why we are out of money. Here we are equal, so we are into money. Look, out of money, at the money, sorry, we are at the money, and after that we will earn profit, so we will be into money, net positive, into money, right? So let's say after 100 the payoff began improve, and that's how it went. So payoff is simple like this, and this is 100. After 100 we have a profit, let's say at 400 of 2 at 120, right? So that's how the call money works. So its formula is really simple. We will don't do any discounting, we will see it at future. So it is maximum of st minus k and 0. So let me tell you, case 1, if the st and our k is 100 for simplicity, case 1 st is 120, so what will be our profit? Yeah, so our profit will be 120 minus 100 equal to 0, and it is maximum of 20 and 0. So between 20 and 0, 20 is maximum, so it will be profit of 20, right? Simple. And if the let's say profit and loss, if the spot price is less than 180, right? So maximum of 80 minus 100, because our strike price was same, and so between that maximum of -20 and 0, so 0 is bigger than -20, so our value of the option will be 0, and that is the more logic between the profit and loss. Yeah. Am I forgetting anything? Yeah, sometime let's say there is a charge. How can I apply? So we take our previous example where we paid -5, and then yeah, -5, and our strike price 100. From that it will go like that. Let's say if the spot price is 102, technically it should be give our it should give us a profit of $2, right? But we paid minus 5 for it. We have to account that. So let's say with our formula 102 minus 100 0, right? And it will be 2 and 0 maximum, and answer will be 2, but we will be still in negative. It's because we paid minus 5, so it will be like 2 minus 5. We paid minus 5, right? So we will be at inter loss of $3. So somebody said that we should not exercise it. But if you think carefully, the loss of $3 is better than loss of losing minus $5, right? So that's why we should exercise it, and sometimes we don't earn profit because of the premium also. So now let's see a put option. It is also very similar, right? Put option. So put option we earn if the market price go down and we sell the option or we sell the stock, right? So let's say our strike price is our current spot price is going 95, and our strike price is, it is current, right? Current 95 and stock price is 100. Let's go, right? And we know that market will go down and not reach the 100 barrier, so it payoff would be like this. Yeah, we paid premium, right? Let's say we pay premium of let's say epsilon. We So it is profit and loss, profit, let's say profit, and here we have our spot price, and this is our 100 mark, this is our 90, and so on, 70, 80, and 90, 80, 70, 80, and 70, and so on, and this is 120, 150, and 170. Let's go. So we paid some amount at first to enter the contract, so our line will start from little bit behind. So yeah, and current is 95. If the market goes down, then our payoff will be like this. As price decrease, we earn more money, right? So yeah, so let's see the cases. Our payoff would fall will be like this, and here will be the strike price. Okay, right? Let's see the case 1. Case 1, the price is 70. The price at the end or the maturity would be 70. And case 2 would be bigger than 100, 120. And the formula for the put is what we say, opposite of it. It is maximum of K minus ST and 0. K minus ST. This is the formula, and let's put our value into it for case 1. Case 1, maximum will be K minus ST. K is our 100 and ST is 70, right? Simple. And maximum will be 30 and 0. So if the market goes down till 70, we will earn $30, right? And if case 2, market goes up to 120, so it will be maximum of 100 minus 120 and 0. It will be minus 20 and 0, and that will be 0 because it is a maximum. So that is a simple concept. of put option. Yeah. Here is a very confusing and very important thing to remember and learn it. I also used to be so confused on this topic. There are option position, right? There are two class of option. There are only two class of option types of nahi. Class of option. One is call and put, right? These two, and there is different combination of position we can enter into the call and puts. So let me down the call. So there is a wrong position, right? Wrong means buying. Wrong means buying or hoping that market will go up. So optimistic or speculation types, buying. So we are in wrong position means we are hoping the market will go up. That too, that is a simple psychology. And short means we are selling, and we also call shorting a writing of option, because we are selling it and another buyer is buying it, so we are writing the option, and we are in short position that we can think that now we are the position where we will benefit that market will go down, from a market will go down. That's the simple thing. And from this combination, we can write. From this combination we have two, three, four combination. Wrong wrong call, wrong position on call option, call as wrong call, wrong position on put, hoping the market will go down, also called as wrong put. Short position on call option, or we can call as a writing of a call option, is called short call. And the short position on put option, that is called short put. So this is the simple thing. And let me tell you, the payoff diagram of wrong call is opposite of short call, and wrong put is opposite of short put. You will understand it if I draw it. Let me draw it, right? So here is our wrong call, and I let me put wrong short call here. To compare, I'm doing right there, and short put here and wrong put here, right? Wrong short put. So A is our wrong call, and the wrong call diagram, you know it. This is our payoff diagram, and wrong call payoff start with here. It's like if the market go up, we will earn the profit, right? And wrong put diagram, we also know it. It is like this. It is strike price here, and we are at negative, and if the strike price is below, if the spot price is below the strike price, we will earn. But the wrong call, right, let's say the short call profit diagram is simple. So if we are on the wrong side, there is another buyer on the short side, so its payout diagram will be exactly opposite. Like if we are at -$5, somebody got a -5 positive, somebody got a $5, right? So we will be at positive of $5, and at strike price, if he is earning money, he will lose the money. If he's earning money, this is strike buy, and then he will lose the money. So it is opposite. Short call is opposite, and like that, this is different, right? Uh, so let me short put is different. If he is paying five money here, we will earn $5 here, and it's go like that. And at K, if he's earning money, then we will lose the money. And if yeah, that's how it work. Short call. It is opposite. So it is a thing to remember, and don't forget this diagram. Remember this. It is very important, right? Let's say understand the different underlying asset. So asset of an option could be anything from stocks to index to currency to commodity to futures to option on interest rate product, option on swaps, anything. So there are so many type of option, so many set of option, and we will see many type of option in our exotic option chapter. But first in this we will cover some basic option like stock option. Simple. Stock option are the option based on any stock like NS, Tata, give me Reliance and all the stock option, right? And yeah, now there is ETP option, most commonly known as ETF. ETF, exchange traded, exchange traded product. ETP is exchange traded product, and ETF is exchange traded funds, right? Exchange traded funds. So ETP is exchange traded product. ETF is exchange traded funds, right? So this is the what we said, the product or a derivative made by the exchanges, and it's what we say, it is tailor made and consists of many stock option or different combination option, different. So you can think like a basket made by exchange, where there are stock of Tata, Reliance, head sector, defense stocks, public stock, consumer products, stocks, and the percentage are different, 100%, 30%, or anything. Weighted are different. It is a tailor made and made by exchange to what we say simulate one sector, right? Say a product for a defense sector will consist of many defense company stocks. A product for a consumer sector or consumer product sector will be consist of stock like HCL or the consumer product stocks. So this is the types. Examples are, I think example are S&P 500. S&P 500, right, is a exchange trade consists of 500 stock. S&P 100, Nasdaq 100, Nasdaq 100. So yeah, that's the core. Yeah, and now there is a um, currency option. Currency option like FX option. So here the underlying asset, it is not the exchange, it is a rate. FX rate, the currency rate. Let's say the US dollar is conversion of one rupees, what we say 85 rupees is $1, right? Let's say if we think the price will increase so much, so we will buy an option, core option for $86. And let's say if the this will be our strike price, right? Our conversion rate 0.86 will be our strike price. and if the price is, let's say, 0.89, so our the ST, and this is K, and 0.85, and that will be 0.04 profit. So that is a more concept of currency. So here the underlying asset is FX rate, that is a currency option, and there is a unit, right? And index option are simple. Index option or indices like Nifty 50, S&P 500 index, right? Indices, so indices you can think as a basket of many stocks that define the market, or capture the market. You can think like a indices like that. And future option, right? Future option are the American type of option. So this is an option on the future price. So American future types. So American future price go up and down. It is stochastic, right? Like that. It is stochastic. So let's say we want our future price between these, and we have to, what we say, neutrify our risk for. क्या मैं टकरा क्यों? Yeah, we have to neutrify our risk for up and down moment. So our we will set the strike price of a future price. Strike price of a future price. Let's say price is 70. So we will buy the future contract in 70 rupees at after 6 months. Let's say na. So that is more idea about, yeah. So let's say now we will think about 10.4, that is specification of stock option. And first is expiry date. So it is, let's say, simple, right? The date at which the contract expired, there is a month cycle, and every exchanges have a different cycle. So it exercise at third week's Friday of every month, right? In, I guess, Chicago Board of Exchange, right? Hmm. Chicago Board of Exchange, COB, right? Third week of Friday, and it will be in USA. I am talking about USA. India, there is a different. So in USA, timing of the trading is 8:30 between 3 p.m. And yeah, I'm not sure about India. It is still 4, I know, but when it start, I 10, I guess. I'm not sure. Yeah. So the stock option in US is from Jan, Feb, March cycle. So there are cycle of 4 months, right? In Jan cycle, the upcoming month of expiry Jan. After Jan, it will be in April, July, and October. And in Feb cycle, it will be on Feb, May, August, November. And in March cycle, it will be March, June, Sept, and December. Let's say you are watching a option in Jan. So if you are, let's say, watching the option before the third Friday, so the expiry will be Jan. And after you are watching after the third Friday, then the expiry will be in April. And let's say the expiry pass on to this month. You can think like a cycle, right? If you are watching in May, it will be in May. If you are watching at after the third week, it will be in August and November, like that. And it is a there is a one type of option that is called REAP, that is uh, wrong term option option known as REIPs. So it have a expiry month of 39 months. So long term option is called REIP. You can think like that. And the strike price, let's say another is strike price. So the strike price determine strike price is the wait a minute, my camera is not working. Yeah, the strike price difference. Let's say here we sorry, to understand that we will see the option chain, so it will be easy for you. Chain, right? You can see here here the strike price is different between 50, 400, 450, 500, 50, 50. You can I should I zoom it for you? So there is a difference of 50 rupees uh, at every strike price. We have an option on every strike price in with gap of 50 rupees, right? So in US, this is set by exchanges. If the what we say, if the option is priced between 10 and $15, the difference between the strike price will be $2.5. And if the option is between 25 to 2 5 to $25, the difference between the each strike price will be $5. And if it is between 200 or more than 200, it will the difference between will be 50 $10, right? In India, the Nifty, there is a difference between 50 rupees. So that is the many market, many different strike price. You have to see in which market you are playing, and according to that. Now let's see terminology. So if I shown you, there are so many what we say, wait a minute. Yeah, so there are so many what we say option on same stock and with different strike price, with different expiry date. So how can we think like that? So it is simple. Let's say we have a stock IBM. So first will be the stock price, right? And second will be the strike price. This is a strike price 160. And then there will be a expiry date October 2021. So if the if somebody give me the price of this this October 2021, so you have to understand that he is asking about the stock of IBM, option on IBM with 160 strike price and October 2021 or 2024 strike what we say expiry date. So you can see here Nifty 24 as Nifty to this is a strike price and this is a expiry date, right? You can think like that. And yeah, I have explained you the concept of intermoney, outer money, and onto money. So let's re go there. Here it is. Yeah, if the money, if we are facing loss of -5, we are out of money. If we are at the strike price and our profit and loss, what we say is equal to 0, 0, we are at the money, and in the money, right, we are in profit. That is a terminology we have to understand it. For you, we can denote it like ST. If the ST is less than K, we are out of money. If ST equal to K, we are into money. And if ST is greater than K, we are out of money. And in put option it will be sorry, in put option it will be different. Let me, so if ST is less than K, if K sorry, yeah, if ST is less than K, we are into money, we are in profit. If ST equal to K, we are at the money. And if KST is greater than K, we are we are out of money. We are out of money, right? My scroll doesn't work. Yeah. After that, there is a type of option called flexible option. So to reduce the dependency on OTC market, so the options exchange made a flexible option with different strike price, different type of option, different asset, that is with different expiry date. So it is a flexible option, you can think, right? And dividend and stock split. So everyone know dividend and stock split. So dividend is a, what we say, extra income or extra money given to a shareholder from the profit of the company. If the company have a good academic, good 3 months, what we say, production period, or they earn more profit, so they will give some percentage to the shareholder, that is called dividend. And to uh, what we say, attract more shareholder and to attract more people to invest in company, there is a stock split. So you have 3:1, 3:1, 3:1 stock price split. If it means that one stock is split into three stock, and its value will be decreased, but the quantity will be the same. If we are holding the one stock of Reliance, after the stock split, you will hold three stock. You will not lose any stock. It is just a, what we say, way of dividing the stocks. Yeah. Generally, whenever the dividend occurs, the spot asset price go down because the dividend is given, and so the market go down, the spot price or asset price go down. And if the stock split is also done, the asset price also go down. So for exchanges, if the dividend is given, the exchange have a mechanism to divide it, or we say, if the stock split, if it is to reduce the strike price, sorry. So exchange, if the, let's say, the strike price is 100, and after the announcement of a dividend, so the price will go down. So uh, st- uh, exchange will also reduce the strike price with certain amount to match the dividend amount, right? So they will do their calculation dividend amount. Okay, and there is no such a mechanism for, what we say, inbuilt mechanism for stock split. But if the m of n is to, if the stock price is m is to n, then we will divide the asset price with n is to m. That is a simple formula, and we can do that. Yeah, I am m is to n, right? I am doing it right to previous value. So you can think like that. And let's go on to another topic, is called position limit and exercise limit. So there is a limit set in exchange, so that nobody can manipulate the stock or buy in so much quantity that the price go up. It is like manipulating the market. So there is a limit set, like uh, for big user, there will be contract size of 250,000. Yeah, 250,000, right? There is also, for small people, there is a small investor, there is a contract size of 275,000 and 50,000 and 25, and so on. So every exchange have a different limit of contract and position limit, that is called the position limit. And yeah, exercise limit, you can't exercise at once, so there is a rule and regulation. And now we will think about trading. In earlier time we used to, sorry, in earlier time we used to trade using hand singer, and it was what we say, very chaotic and unprofessional. So nowadays all the 95% of trading happen using computers, electronic trading, computer. all the exchanges are computerized, and you can buy the stock by what we say sitting in the home. That's how that's how simple it is. So let's learn about market maker. Market. Why why it is so slow, my market maker, right? So market maker are the person who right say, are selling. Most of time they are selling, and most of time it is exchange. Market maker are exchange. They will give us a bid and ask price. Bid and ask price. The bid price is the maximum. Minimum. Sorry, I am confusing right now. So bid is the maximum price a buyer can give for a product or a derivative, right? And ask price is a maximum, or sorry, ask is a minimum price asked by seller to sell. So the bid, if we have to buy anything, we will see at the bid price, and if we have to sell anything, we will see at the ask price. That how it works, and it is called the difference between bid and ask is called bid ask spread, and this should not be big. If it is big, then we can think like the market is not efficient and something is wrong, right? And yeah, so for example, the bid ask price should be between 0 point in difference of $0.25 dollar. Let's say if the ask price is 5, then the sorry, if the bid price is 5, then the ask should be 5.025 for a healthy market, right? Yeah. And yeah, that's simple, how simple it is. And offsetting the order, right? It is an important topic. Next topic is offsetting the order. So offsetting means entering into the opposite side of a contract, right? So if we buy, we are on the wrong call, at maturity we will sell the call. So we will be at the opposite side, right? We seen the wrong call, opposite is short call. So we will enter into offsetting position. So that is offsetting position, and it's how that simple. And yeah, and now trading cost, right? There are trading cost required for trading the option. So there is a fixed brokerage, fixed, right, say 0.25 dollar fixed brokerage fee, and plus per contract fee. If we buy 5 contract for 5 option contract, then we will pay the percentage fee of 5 contract, let's say 0.005 and into 5. So that's the trading cost. And there's a brokerage fee, a convenience fee, handling fee, and many things, right? Every exchange have a different, and now it is a margin requirement. So margin requirement like a future, there is also the same concept in the option. And we require right, say minimum 50% of the asset or price of the broker to keep as a margin, right? That is called as a buying margin. If we are in the call position, we are keeping 50% of extra money in the account, that is buying my margin. And let's say if we sell the put or sell the call, so we are in the short position, right? Still we have to keep a margin, because what if he exercise, right? If he exercise, then exchange should pay him, and if we don't have it in a margin account, then it will be how exchange will pay it, right? And yeah, and writing a naked option. So naked option is a, right, Yeah, naked option you can understand like a option with no hedging, option with no position in offsetting position in stock. So many of the investor or a trader, if they are buying the option, they will also buy the underlying stock, so that if the option value decrease or option is in the loss, we can earn profit with stock, underlying stock. But most of the retail investor that doesn't have a knowledge about the futures and option market, they generally buy only option, and that is called a naked option, and it is highly risky, highly risky, highly risky. And it is not suggested to have a naked option in your portfolio. And the what we say margin required for naked option is generally more than what we say option with offsetting position, right? Yeah, and I think there is also a OCC in USA, OCC option clearing corporation that handles the margin requirement, credit defaultment of contract, and everything done with trading related to option. It is like a clearing house for option, right? We have a clearing house in future, right? We have a OCC in option market, and exercising option is done by, right? Okay, so here one concept is there. So here the how it's work, the buying and selling or exercising of option, right? So we are the investor, retail investor. We call the buyer, give the order to buy to broker, sorry, of let's say call option. Broker will notify the OCC, and OCC will clear the trade, right? So there is we communicate in between the broker, right? And in now term of exercising, this format is like OCC, broker give advice to OCC by retail, and this how the trading of OCC is done. And the taxation, regulation and taxation are very different from between many countries and many exchanges. So I will not cover it in detail, but there is taxation is like capital gains, two type of normal tax or capital gain tax. If it is in India, if it is for a long term investment, then it is a capital gain tax. And then there is a income tax and many tax. Vast sale rule, you can read it. And warrant and employee stock option, right? Let's cover that warrant and employee stock option. Even though we have a complete chapter on that, warrant are the option issued by a financial institution or a non-financial corporation. So option issued by corporation is called warrant, right? Warrant to buy 1 million, put warrant on gold and like that. And employee stock option, ESO na nahi. Employee stock option is like the to motivate the employee of the company, so that after a certain work of service, the company will give option on of stocks of their company, where user can exercise it at the strike price, right? And OTC market, I covered types of market, yeah. So that's how the option work. It is very simple and basic. And now we will cover more complex topic about trading strategies using option, like strangles, staggers, butterfly, and types of option, pricing of option, risk management. And I'm looking forward to make the video on it, and I will try to make as much I will try to make as much as video and as much as fast I can. And thank you for watching this video, and I will end this video. Bye.